Hey folks, Sean Plummer over at the Annuity Expert. In today's video, we're going to go over how a long-term care annuity works. One of the most essential items that a retiree can get as they age is long-term care insurance. The problem with long-term care insurance is that it becomes increasingly expensive to a point where it's not affordable, and a lot of folks who have traditional long-term care insurance end up canceling their policy because they just can't afford it. And other folks who have traditional long-term care insurance, they don't like the fact that it's use it or lose it insurance and it's a waste of money. Okay, when you're looking at purchasing an annuity and you're specifically looking for a way to fund long-term care expenses, there are three different ways that you can do that with an annuity. The first way, and the most popular way, is purchasing an annuity with a lifetime income rider. Okay, a lifetime income rider is essentially an add-on that you add to your contract that contractually guarantees a fixed income for the rest of your life, regardless if there's any money in the account. And in a lot of these lifetime income riders, there's a benefit called like an income doubler or a long-term care rider. And essentially, just like the name describes, what happens is whatever your lifetime income amount is, that fixed amount that you earn on a monthly basis, it doubles, sometimes triples, to help pay for a nursing home, home health care, assisted living. If you're terminally ill, it'll accelerate your payments. And it'll continue to pay for those expenses until your account runs down to zero. And then when it runs down to zero, the fixed income reverts back to the original income payment and continues to pay you that original payment until the day that you pass away. The pros and cons of that is that it's paying your money back faster to you. The con on using that method is that unless you have a large amount of money in an annuity, the income doubler or tripler that will pay for that nursing home, home health care, assisted living doesn't scratch the surface. So if you're getting $10,000 a year from your annuity and it doubles to $20,000 a year, but your nursing home is $100,000 a year, $20,000 a year is not really going to scratch that surface, right? But it is an option there just in case. So that's option number one. Option number two is most deferred annuities, and that's fixed annuities, fixed index annuities, variable annuities, have built-in health-related crisis waivers. Basically what it means is if you go into a nursing home or home health care or assisted living, and you need to get access to a large sum of money because these services and facilities are extremely expensive, the insurance company will typically waive all surrender charges and let you access into your annuity's account value in a lump sum to pay for these things. So for example, let's just say you have a $100,000 annuity. You can't meet 2 out of 6 activities of daily living. That's eating, feeding, bathing, mobility. If you can't do 2 of those things, or you go into a nursing home for 90 days and you can prove it and show it to the insurance company will then waive all surrender charges and let you access that $100,000 without any sort of penalty to help you pay for those senior services and facilities that you need. The third way, in our opinion, is the best way to pay for long-term care among the 3 options, is what's called a long-term care annuity. Okay, and a long-term care annuity is a type of fixed annuity. Okay, that means your money's protected, it's not in the market, you're going to earn a fixed interest rate in the core account. But what it will do overnight is it'll double or triple the value of your investment to pay for long-term care needs. We're talking nursing home, assisted living, somebody coming in to do chores at your house, home health care, hospice, things of those nature. And basically what happens is when you apply for a long-term care annuity, you go what's called simplified medical underwriting. Simplified medical underwriting is really just looking at your prescription drug history, looking at your health history, and based on the health history and the prescription drug history, they're either going to double your account's value or they're going to triple your account's value depending on how healthy you are. So I'll give you an example. Let's say you have $100,000 and you want to allocate this to a nursing home, because a nursing home costs on average $90,000 to $100,000 a year for a private room. Instead of using that $100,000 to self-insure those facilities or services, put it into a long-term care annuity. If you're in fairly good health, that $100,000 can be worth $200,000 or $300,000 to pay for that same nursing home that you would have paid $100,000 a year out of your own pocket. What will happen is you'll go find your facility, find your service that you want, send receipts to the insurance company, and they reimburse you the cost. What happens at the time of death is whatever's left in the account, not the $200,000 or the $300,000, but your initial $100,000 will go down to beneficiaries in a lump sum. No unused money, no use or lose it. You can improve whatever facility or service that you get instantly, assuming that you're in decent health. And another good perk is you can put your spouse on one policy, so 2 for the price of 1. So if a long-term care annuity is something of interest, or you just need help looking for options to pay for long-term care services, contact us over at the Annuity Expert. Our financial advisors are long-term care certified. They have options to all different types of ways of paying for that long-term care and getting the most bang for your buck. Like, subscribe, and we'll catch you on the next video.